Hi guys, how you doing?
Good, how are you?
Good.
Doing good, doing good. Thank you all for being here today. Really appreciate it. So today we have a great presentation going on algorithmic trading and market making. We have some excellent speakers with us to kind of tell us more about their background, their company HedgeTech, and pretty much give us a lot of insight that can help us propel our professional endeavors. So my name is Malik Papaye. I'm currently the VP of Alumni Relations for Alpha Kappa Psi. And today we have Laurent and Tom from HedgeTech. If you guys want to give us a quick background on your experiences and talk about HedgeTech a bit.
Sure. Thanks, Malik. Thanks, guys, for having us. So I'm Laurent. I'm one of the two co-founders of HedgeTech. Tom is here with me. So essentially what we do at HedgeTech is that we do algorithmic trading with a focus on market making for digital assets. And so for me personally, my background is in pure math and economics, and I've been trading for around probably 6 years now, Forex, stocks, digital assets now. And my interest really is strategy design. Tom?
Hi, this is Tom. I am a co-founder of HedgeTech. I have been an algorithmic trader for 7 years. I started in China's futures market and then moved to digital assets markets. Right now at HedgeTech, I am mainly in charge of the infrastructure design.
Awesome. Thank you guys so much. So can you guys kind of give us a little intro in terms of how you guys got started with algorithmic trading? Was it from kind of your endeavors in college? Was it something that you kind of came across after graduation? What exactly got your interest into?
I think we have two different stories with that regards. I started trading in college, as you mentioned, for myself and then for some quote unquote high net worth individuals. But it was very tedious essentially because I had to place my orders, in the morning, go to class, and then see which got filled and so on and so forth. And it was very mechanical and repetitive. And essentially in my mind, algo trading was sort of like for like you needed a lot of like means and like financial means especially to set up the infrastructure and to be competitive. And so then later after graduation I joined this company Pacific Block where I met Tom. It's a Chinese company doing consulting and some trading. And they essentially imported to the US their their business model. And there I met Tom, who was an algo trader already. And essentially, that's how we bonded. I started asking questions about algo trading. I started, getting into it, and I found it pretty cool that you can actually make it like automatic, and you don't have to pay attention to. As long as you design it very well and very carefully, you don't have to pay attention to execution that much. It's fairly brilliant in my opinion.
So for me, when I started trading, I learned that to be successful in trading is simply repeating a set system that is proven in the past to have a positive expectation. So there are a lot of repeating. So since it's very repetitive, so I was thinking it will be the best to automate it. So I learned about exchange APIs and started to implement my first trading algorithm, and that's how I started.
You mentioned exchange APIs. Can you speak on what that is exactly?
So API is application programming interface. It allows you to contact to a specific server with your local computer. For example, the exchanges server. So instead of going to their website to place the order, you can just simply implement your own code to place or cancel order, right, and to gather data from the exchange.
Actually, you said local computer, but it's also true for like remote computers. Like if you're running it in the cloud, for example, you can also have this dialogue directly with the exchange server without going through their user interface. So that's how you pretty much connect your algos directly to trade on the platform.
Awesome, thank you. And guys, of course, if any of you in the audience have any questions, feel free to raise your hand virtually, and I'll definitely let you get your time to speak. Now, kind of hearing about what you guys are saying with APIs, it's clear that there's so many different forms of technology within financial services. So can you guys kind of speak on this idea of Fintech that we hear a lot about in the news and kind of what that means to you?
Right. So I'll give you my perspective on fintech. So, sometimes when we go to the bank or like to fill out some paperwork, and we're asked about our industry and what really which sort of box we fit in, we cannot really say finance and we cannot really say tech, right? So it's like we're not really a finance company in that we connect the algos directly to the client accounts. So we don't have custody of the funds, we don't have custody of the accounts even. But we're not necessarily like a tech company per se, because we only have one type of application, which is really finance. So when the line kind of gets blurry a little bit, this is where when you're at exact intersection of finance and technology. That's my perspective, at least on fintech. Yeah.
Awesome.
What is less careless? What is less careless?
I'm sorry. Can you repeat that?
So, because I have to pick up a.
I don't think. Malik, did you hear the question by any chance, or?
No, I did mute by accident. That might have been a mistake. Not
Okay.
sure.
All right.
I know
No
we have a question from someone in the audience. They said, from Uday, which program language would you recommend / would be optimal for algorithmic trading? If you guys can give your response to that.
So the most popular languages for algorithmic trading are Python, C++, and JavaScript.
Mm-hmm. But so C++, you have this sort of speed advantage. It depends on whether or not you care about your latency and your execution speed. So essentially, when you have an algo, for example, and you have a simple execution loop, right? Do you really care about how long this takes or not? And then you have this dialogue between your server or your local device and the exchange server. So you add this kind of extra latency, right? So with Python, with a fairly complex algorithm, you can achieve even nanoseconds of execution time. And then latency depends on if you have co-location services with the exchange server or not. But usually it could be ranging from, a second would be extremely long, but let's say hundreds of milliseconds to nanoseconds if you have co-location or less. But Python is already pretty good. It's relatively simple to sort of manipulate, I guess, and to get your hands on. And it uses a lot of modules that are that have the same execution speed as C++. Now C++ allows you to have faster execution speeds too, but it's fairly more complex and more involved than Python. And then there's something coming up. Recently, we've heard about Rust and everything. I don't know about any applications in terms of algo trading yet, but yeah, that's kind of the overview of what programming languages are suited for it.
Awesome. Now, with the hires that you recruit, are you looking for people who kind of have that info / computer science background and know how to apply it in the financial services sector, or is it something that you teach through your training modules? Pretty much, what exactly are you looking for in candidates when it comes to recruitment?
So for candidates, we have different kind of positions. We have a marketing team that for marketing team, we look for marketing skill. So he has to understand the product,
mm-hmm.
and he has to be able to explain the product to people who is not in this industry. And we're looking for software engineers, of course. And also we're looking for people who design the strategies,
mm-hmm.
so which has more financial engineering background. Yeah, that's pretty much what we're looking for.
And to complement this, I would add, more and more people are looking for, graduate degrees in physics or math for the quant heavy or the research side, right? When it comes to strategy design and modeling and that kind of stuff, and signal processing and everything. And then, as Tom said, you have the software dev, where you need to actually build the infrastructure in a very efficient way. And then obviously sales, right? So yeah, these are the three main areas that we cover in the company.
Awesome. All right, awesome. Thank you. And kind of looking at all these different functions within your company, it all kind of leads to this one overarching goal of market making. That's your main objective. So kind of looking at market making, can you kind of give us your main kind of definition on what it is exactly, and some of the different strategies that you guys implement to be the best market makers out there?
Sure. So just to give you or to give people who don't really have an idea of what market making is, like the essence of it. If we simplify, trading, and we just talk about basic spot markets where you just buy and sell, period, right? Like we're not talking about margin, shorting, or anything. But you essentially have two types of orders. You have maker orders and you have taker orders. Taker orders, you're going to get filled immediately, but you don't control the execution, like the price at which you get filled, right? And conversely, for maker orders, you do control the price at which you will be filled, but you don't control when you will be filled. And so essentially what market makers do is that they're going to be the ones that place those those maker orders, and they're going to populate what we call the order book, so that regular traders can come in and they can take those orders. And essentially, by placing those maker orders, we make the markets more efficient in that we narrow, the gap between the buy side and the sell side. And we also make it less problematic for those who want to trade a large volume to trade directly on the market at market price. So yeah, that's market making in a nutshell, I guess. Happy to provide more,
Hi, my name is Catherine Keating, and I'm a freshman, and I'm studying a major in computer science. And I've seen a few situations where the listed price of a stock isn't actually what you can buy or sell it at. Is that a situation you deal with often?
I'm not sure, Catherine. I think there's some background noise, but I'll try to answer based on what I heard from your question. So I think you were asking, is the execution price not the price that you see on the interface, when you place your order? And if this is your question, why is there a discrepancy between the price that is supposed to be the market price and the price at which you're getting filled? This is called slippage. Essentially, when you place a certain amount to buy or to sell at market price, it's going to hit other people's order and other people's maker orders more specifically. And so essentially, depending on how the order book is laid out, right? So depending on how many orders and what's the volume of the orders at different price levels, you're going to have a weighted average of for the global amount that you want to buy or sell, you're going to have a weighted average in terms of like price times quantity for each price level. So that's why there is a small discrepancy, and our role as market makers is precisely to lower slippage. So essentially to make sure that traders can trade at a fair price essentially whenever they want. And market makers are supposed to quote on both sides. I mean, we can talk about it in a little bit, but yeah, essentially we're here to lower slippage. Yeah.
Is that your question?
Yes, that was exactly my question. Thank you.
Okay.
Also, how important is runtime in executing these strategies?
How important is runtime?
Yes.
Tell me more.
So it depends how your infrastructure is set up. So basically, the most people do it is to have a lot of virtual machines, and maybe different virtual machines has a different job to do, and different virtual machine will have a different runtime. So it depends. If you are a CS major and the position that you're going to get into is infrastructure design, then the runtime is very important.
Mm-hmm.
However, if you're more on the research side and your job is mainly for strategies, then it's not your major concern.
Right. So it depends. In my opinion, it depends on which area you want to focus on. Is it, as Tom said, infrastructure design, in which case it's extremely important? Is it strategy design, in which case it would be somewhat important? But even for example, when you do some research and you want to backtest a strategy, for example, like you still need to optimize the like the backtest so that you make sure that you don't run into like week-long backtests just to have your final expected returns or something like this, right? So essentially, at pretty much every step of like designing either the infrastructure or the strategy, or testing the strategy, or making it to production, runtime is fairly important.
Great, thank you. And then also, finally, do you guys choose what language you're going to write the code in based on the strategy that you're decided to implement, or do you write all of your strategies in the same language?
Yeah, so we try to uniform, to make it uniform across all departments, right? So for example, we might require that everyone uses C++. and this is just for like it's like a internal thing that we have going on, but maybe some different companies they operate differently, but at least for us we try to uniform everything that we write, unless we have to interact with very specific applications. So for example, if we have to build like a web interface, for example, we would still have to obviously like use JavaScript or something like this. But in general speaking, for strategies per se, we try to make it uniform. And then does it depend on strategies? Yes, it does. For example, if you're, I'll give you an example of digital assets, also known as crypto, formerly crypto, I guess, because now it's so diverse. But let's talk about cryptocurrencies for a second. Back in the days in 2018, the exchange infrastructure was not very well designed or not well developed, and so it wouldn't matter that much, what your execution time would be, because you would have such a big latency with the servers, and their API request limits were extremely, sort of like small. So you couldn't like place a lot of requests per second or per minute even for some of them. So in that instance, runtime doesn't matter a whole lot. Of course, it would shorten your execution loop or like your threads and everything, but it wouldn't matter that much at the end of the day. But nowadays, even in crypto, people are starting to trade in the order of magnitude of milliseconds or nanoseconds even for some. So it's getting increasingly important. Yeah.
Thank you for those questions, Catherine. Another question I have is looking at your website. I see that you guys have offices in Boston and Singapore. So do you guys, is it kind of like is there a central form of work between each office, or is each office kind of independent in terms of market making and the strategies being used?
Yeah.
So come into play, etc.
So this is mostly a matter of jurisdiction in terms of regulation, because different country has different regulations in terms of securities and finances. So the reason why we set up two companies is to comply with two different regulations, and different kind of regulations will fit different different clients. Clients from different country and different type of companies.
And essentially, as I was mentioning when I was trying to answer Catherine's question, we try to make everything uniform. So although it's like on paper it's two separate entities, but essentially like the technology is completely shared among those two entities. And as Tom said, it's mostly to either like deal with Asian clients who like to deal with Asian companies, and especially in digital assets, they're like the US are very strict in terms of regulations, and so they prefer to deal with offshore companies if possible, and this is precisely why we opened the Singapore company. Yeah.
Great, thank you. And kind of looking more at the industry, can you guys speak on some of the industry players that have a lot of market share in terms of market making, who you guys are competing against?
So basically, market making interact with all kind of players in this industry. So as designated market makers, you are hired directly by issuers. So they hired you to make sure that their market has enough liquidity. And then you have exchanges. Of course, some exchanges will compete with other exchanges in terms of liquidity and spread. So they will hire designated market makers to improve their liquidity and reduce their slippage. Also, it also plays a very important part to retail traders, because we place these limit orders on the order book, which is basically the blood of the market. So if there's not enough liquidity, the retail traders will face huge slippage. They will not have enough order to take for them.
Right.
So yeah, it interacts with all kinds of the industry players.
Okay. And when you guys were speaking on the different functions within your company, I'm not sure if risk management was mentioned, but do you guys have like a risk hedging team? How exactly do you guys go about that?
Right. So this is embedded. The reason we didn't mention it is because it's embedded at the core of strategies themselves, right? So whenever you design the strategy, you want to make sure it's immune to market manipulations. It's immune to different kinds of like market environments, you know, like and things that you can face on the markets in general. But in terms of risk hedging for market making, because this is our focus, you know, like a couple of things come up, you know, often from clients. The first thing is how to make sure that the inventory is safe. A couple of things that I guess we'll not mention that are very specific to digital assets, but broadly speaking, imagine that you have like a pair Euro USD, right? And you're trading essentially on this Forex market, and you have a risk as a market maker, especially a designated market maker, to hold both currencies, right? Because, you know, one could go down, price could go up, and so we want to make sure that we hedge the risk fully. And one way to do this is to open you know, positions on futures markets, right? Derivatives markets. So essentially what we would do is that we would make sure that if the price goes up, we will not gain anything, essentially. This is kind of like the drawback. But at the same time, if the price of one currency goes down, we make sure that we open short positions to compensate this. So essentially, when it goes up, the short position is losing. When it goes down, the short is winning. And essentially, you balance out your risk. And then there are, you know, strategies in terms of market making, like order book replication. So for example, if you're, you know, like working for a certain exchange, you can take liquidity from, you know, another exchange that has more liquidity and literally replicate the order book with like some price increments, like a difference in price increments, I guess, or like, you know, spacing of the price levels, so that you make sure that you don't lose to trading fees and other, you know, sort of like tedious things that we have to deal with. But then you make sure that you fully hedge the risk. So whenever there's an order that is filled on that market, you immediately replicate it on the other market.
Okay.
And in terms of the positions in our company, we don't have a specific position that just focused on risk management, because there are different types of risk. For example, what Laurent mentioned, these kind of risk, the strategy team, the team who designed the strategy should take care of it. And for other type of risks, for example, cybersecurity,
right?
We will have software engineers to make sure that our infrastructure wouldn't have any potential breach.
Right.
So they're taken care of by different positions.
Right.
They're
yeah. Makes sense. Awesome.
So what's a good way that someone interested can get started? Do you guys have any advice on a platform I'd be able to use, like mock strategies and test how like my strategies and algorithms do on fake money?
Yeah, there's still a little bit of background noise. I think you were asking about the best platform to start with if you're interested in algo trading.
Yes.
The answer depends on a few parameters here. First off, it depends on which market you want to trade on, right? So obviously, if you want to trade on, you know, like very specific, you know, derivatives and options and stuff like this, and you're not going to use the same brokerage firm as if you were going to trade, for example, I don't know, simple stocks, for example, or Forex, or, you know, it really depends on, first of all, the market, because you need to find the market where you have the most liquidity or market inefficiencies if you want to solve them, right, and profit from it. So that's the first thing. The second thing that you need to consider is accessibility of data, right? So for example, if you use like a brokerage firm like Interactive Brokers, for example, these guys, they have a fairly robust and solid API and server infrastructure, and they're like pretty good at it. But the only thing is that you have to pay for the data feed, right? So if you want to gather data and you want to backtest your results, you are dependent on, you know, essentially like you know, like a monetary value to backtest your results. So this can be costly. And then, you know, sometimes if you want to establish a strategy that, for example, is using not only like price and derivatives of price or indicators or that kind of stuff, but if you also want to backtest or try and backtest, I guess, a strategy that incorporates, for example, order book data, because there's no historical order book. This doesn't exist on any platform. You would have to yourself, you know, manually sort of like save this order book data. And for example, IB, to, you know, sort of like stick to the same example, IB only offers, you know, a couple levels around market price. So you're not going to see the full order book. They do, but you don't.
Can you expand quickly on an order book? I'm not.
Right. Yeah. Absolutely. So essentially, like a brokerage firm is going to receive all kinds of orders. They're going to receive maker and taker orders. And so the maker orders build what we call an order book. So essentially, you will have two sides, the buy side, the sell side, and then you're going to have, for each of those orders, we're going to build what we call an aggregated order book. And so at each price level, so essentially whenever a trader places a maker order and they're going to input a certain price, this is going to be saved in the order book if it doesn't have a counterpart. So for example, let's say that you want to buy Euro USD and I don't know, like 1 USD is 0.8 euros, right? And you place a buy order at 0.9, obviously you might hit someone else's order. But if you place it at 0.6 because you anticipate that there will be a downtrend at some point, then it's going to be recorded in the order book. And whenever there will be whenever there is a counterparty later, you will be filled at that point in time. Yeah, so the order book essentially is like a compilation of maker orders, so orders that specify a price that are not filled immediately and don't have an immediate counterparty. And so you have two sides, buy, sell. Obviously, the buy side is lower than the sell side, otherwise they would get matched, right? Because essentially, this is a concept in econ when you have a buyer who is willing to buy higher than what the seller is willing to sell at. They get matched at a price in between. And on exchanges, it works somewhat differently, but this doesn't matter that much.
Thank you, Captain, for those questions. You have a question as well. I know you had your hand raised for a while.
Thank you. First of all, Laurent and Tom, thank you for taking the time out to do this webinar. You did mention about designated market makers. So how do you differentiate yourself from the profit-driven market makers in the crypto industry?
So designated market makers usually, because they receive either monthly or yearly payment from their clients. So they're obligated to quote their orders within a certain spread, or they're obligated to provide this amount of orders within a certain amount, a range of market price. But since you're obligated to do so, your ability to make profits might not be optimized. However, profit-driven market makers, they don't have this obligation and they don't receive payment directly for quoting the orders. So they can do whatever they want. They can do whatever they want in order to optimize the profit that they make directly from their strategies. This is the key point.
So yeah, that's very accurate. And there are two things actually. There's efficiency and there's profits. So designated market makers, they're optimizing efficiency of the markets. And then profit-driven market makers, they're optimizing their strategies to generate as much profit as possible. The thing is that it's kind of like blurry because designated market makers do realize profits when the market fluctuates within a given range or whatever, but they do realize profits. And at the same time, profit-driven market makers, they do increase somewhat, or they do improve market efficiency somewhat. But yeah, that's the two key points that make a difference.
That makes sense. Thank you. I'll go back to Malik.
Thank you. Could you guys speak on your kind of focus on designated market making for digitalized assets and kind of
on the digital asset side, we focus on designated market making. Yes. And for profit-driven strategies, our alpha strategies don't necessarily are all market maker strategies.
Mm-hmm.
Okay. And now in terms of, I know we talked about the technology before, some of the technology used within your company. Kind of, is there any technology that has revolutionized your work over the past coming months or past few months with COVID, or that you're looking forward to coming out in the next few months, next few years? Anything new?
So the technologies in trading, in my opinion, is more like accumulation of things. For example, at first, exchanges has adopted API and they share with some of their private partners with their API, and slowly up they open their API to public, so that it will be very algorithmic trading became more accessible to regular traders or smaller institutions. And then there's the adoption of machine learning. Machine learning is actually not a very new technology. However, it's lately adopted in algorithmic trading is because the market has accumulated in a sufficient amount of data for them to apply machine learning models. and also the slowly increase of the computing power we have in our devices also made this possible. And also there are something relative new but not extremely new is the GPU training. They use the graphic card to train their models, because compared to CPU, GPU has a lot of processors. However, the combined power of every processor don't have the same computing power as a CPU. However, you can do a million threads so compared to CPU, you can only do several threads. So it applies very well in neural networks based machine learning model. So this is some improvement, and that's the reason why the NVIDIA graphic cards are sold more for training than for gaming computers.
Right. And one more thing, I guess, is accessibility of hardware. And this also impacts latency. You know, we're talking about co-location services, for example, from exchanges and stuff. The fact that you can just rent, you know, like millions of machines and scale, you know, very easily and for a relatively like reasonable fee is somewhat it's a pretty good thing for algo trading, because you know, like you have access to all those like big computers and you can use exactly the computing power that you actually require, and you don't need to maintain, you know, servers or like, you know, big, you know, warehouses or anything of that sort. So yeah.
Awesome. So now we've kind of been able to go through looking at your website, the main strengths that you guys have, from your strategy to your technology, and the last strength listed is your pricing structure. So you guys talk about having the most competitive flat fees, you don't take a con profit, no charge on integration fees, no hidden costs, and that's directly from your website. So how do you guys, in terms of the way you guys are structured, financially, operationally, how are you guys able to have all these benefits?
Right. So from like a very like very simple perspective, I guess, we're a small team, so we don't have the same, you know, costs or like, you know, like the same sort of like responsibilities as a big, you know, trading firm like Jump Trading or Virtue or you know, like even major banks have, right? So you know, being a small team, you don't have to pay that many employees, and so as a result, you don't have to have, you know, like a big chunk of your revenue going to, you know, expenses. So this is one way that we're able to make our clients pay less. Another way is that we're fairly scalable in terms of infrastructure, in terms of servers, in terms of, you know, implementing new strategies and everything. And then the third thing is that you know, some competitors would take, you know, weeks or months, and this is also proper to, you know, big firms, right? You know, like in a startup or in a smaller firm, you have less friction, right? So like whenever, you know, like you start working on something, usually it goes faster, and you have less steps, you know, in terms of you know, going up the hierarchy and everything. And so the fact that it's smoother also allows you to save on time. And so, for example, you know, big firms might take, you know, weeks or months to integrate new exchanges, when we take a few hours. Or, you know, we say 24 hours on the website, but sometimes it could be much less, just to be on the safe side.
That's awesome. Now, as you know, as you guys grow, hopefully in sometime in the near future, how large do you see the scale becoming? Do you see your scale becoming to a point where you're not able to operate that quickly, as you've been speaking on so far? Because, you know, these more well-established firms kind of have more turnaround time, I guess.
So the point of designing a scalable infrastructure is that the infrastructure has to allow this. The difficulty of operating one strategy is similar as the difficulty of operating hundreds of strategies at the same time. So we will expect our company to grow very fast, of course. At least for designated market making in digital asset field, we would expect us to occupy a fair amount of market share across all, at least the spot market pairs. And we have the capability of doing that because the scalability of our server infrastructure.
I think one other key point, aside from infrastructure, is also how you sort of like want to build the teams. And so, for example, if you look at Renaissance or, for example, Jane Street, right? These guys work in teams, right? And so they don't have like the same problem where they're like competing against one another. They're each working on their own project, and it's almost like small research labs within the firm, right? So essentially, having like this team spirit as well can help. And then, if you were wondering in terms of competition in the traditional industry, some of our not direct competitors because we don't trade on the same markets, but for example, Virtue, which is in New York, is also pretty big in terms of market making. Jane Street is doing prop trading market making, so that's a little bit different. But they have like hundreds of employees. Same with jump trading. In fact, jump trading, we're trading on the same markets as they do on certain digital asset markets. And we're a very small team when they have like 700 employees scattered around New York, like Sydney, I believe, and Hong Kong and everything. So, there's potential in my opinion.
Okay. And speaking of places like Sydney, New York, Hong Kong, are you guys planning on eventually relocating or expanding to those areas as well? I think you said Virginia you're in right now. Kind of, do you think there's a deficit to not being in New York City, not being in that financial services hub? Just wondering.
Asia is definitely going to be a very important place for the future of HedgeTech.
Yeah.
Because first of all, because of the industry we are in, digital assets are very big in Asia, and also the regulations are less complicated than what it is in the United States. So yes, we will have a big part to play in Asian market.
Mm-hmm.
And also for the US, we are gonna still keep it and expanding our trading side on traditional finance markets.
Mm-hmm. So I don't think there's a big deficit in terms also of not being in New York City, because especially nowadays you can see how everything is sort of like flowing smoothly, right? With like Zoom and all the technology that we have now. We can work from home. We can work entirely remotely on strategy design and pushing code and pushing commits to the servers and everything. So we don't need to be like physically present nowadays in the same office necessarily to operate. So this is a big plus, and we don't see a big hindrance in not being in New York really, because we talk. To be honest, we haven't seen most of our clients in person. That's how crazy it is. And then we manage pretty decent amounts. So it's like you don't necessarily need to be physically present anymore. It's true that for networking it would help a great deal, certainly. But you can always travel for conferences and everything. And then I think the fact that we're in Cambridge, there's MIT right next door, there's Harvard and everything. So we have access to these guys as well, and all the tech firms around, and pharmaceuticals, and like this whole very stimulating environment. And I think that being in California, Palo Alto, for example, would be also a great idea for talent acquisition. So yeah.
Yeah. So basically, with the current technology of the servers, infrastructure, and those server providers, your physical location really doesn't matter, because no matter where you are, you can rent a server right next to the exchange.
Mm-hmm.
You can just stay in somewhere like Malta or some other very remote places. You can still have servers in Asia, in North America, in Europe. Mm-hmm. So your physical location is more dependent on the jurisdiction of the regulation, and less dependent on the location of the exchanges
and time zones of your clients as well. Yeah. This matters a lot actually also, because obviously digital markets never close, whereas forex is a fairly wide open market. But stocks, for example, they have very set dates, although you can trade around the clock. But digital assets, you have to be on 24/7 for each time zone. So it's also more and somewhat more involved in that regards. Yeah.
Okay, awesome. Thank you very much.
This is a little off topic, but I've done a bit of research on different approaches to algorithmic trading, and I've seen things like reversion and momentum. And you mentioned you've seen like machine learning kind of take over with new approaches. So I was wondering if you've ever find that simple approaches still work?
Sorry,
Yeah,
I
we
heard
heard a lot
machine
of
learning,
background
but
feed.
I didn't hear a lot. I heard Bloomberg maybe, but I'm not sure.
No, okay, I can try and repeat it if you want.
Can you write it down? Maybe it'll be
yeah,
it'll be
because
better
Type
if
it
you
in
repeat it.
the chat box.
Yeah.
Here, can you hear me now? Is this better?
So well, let's try. We'll try. I don't promise, but we'll try.
I've done a bit of research on different approaches to algorithmic trading, and
Yeah.
I've seen things like mean reversion and momentum. And you mentioned like that you've seen machine learning kind of take over with new approaches. But I was wondering if you ever find that these simple approaches still work.
You mean the old approaches or machine learning approaches?
Algorithmic trading strategies.
Yeah, it of course it will work. Like no matter it's mean reversion, momentum, trend following, or machine learning models, they can all work as long as it's set up properly.
Yeah.
Yeah.
So a couple of things. First, you're going to compete. For example, we had a client coming to us. This is back when we had prop trading for external investors. Now we don't anymore. We do everything internally. But so we had a client coming to us, and they wanted us to do arbitrage on certain markets. And they were essentially investing in a couple of funds that would do exactly the same thing. And I was explaining to the guy that we don't want to do it simply because we're going to compete against those guys. So essentially the profit margin of these guys is going to decrease over time, and they're not going to understand why necessarily. And our profit margin wouldn't have been as good as what their profit margin was before. So essentially, you know, when the space gets crowded and you're all using the same strategy, so if you're using, I don't know, like a momentum strategy or any kind of like a strategy based on indicators, and some other people are using the same strategy on the same markets, you're going to compete against those guys. Much like, for example, if you see like a good market for profit-driven market making is a market on which a spread is huge, right? So the market is actively traded, but the difference between the buy side and the sell side is pretty significant. So essentially, you're going to always profit from this difference, and it's pretty like significant. But if you, as soon as you start competing with another market maker, they're going to start, you know, outbidding and out asking, quote unquote, each other, and the spread is going to be minimal as soon as you have two market makers on the same market. So, you know, like, you know, if the space gets too crowded, the strategies will not work, or work less if, you know, they will work not as much over time.
So in general, you're competing with people that is using the strategy that has the same type as you.
Right.
You're not necessarily competing other type of strategy. So for example, a new type of strategy emerge. The ability of your old strategy doesn't necessarily get affected. For example, if you're using a mean reversion strategy, for example, and you trade on a 4 hours candle on a time scale, and there are people who use machine learning. There's something in machine learning is that their strategy require a huge amount of data. So they will be trading on a minute chart, so that they have enough candles to train their model. So you trade in different time scales, so you don't compete directly in that terms.
Yeah, and
because they're capturing profit with small fluctuations, and however you're capturing profit in a larger scale of fluctuations.
Yeah,
oh, that's interesting. I've never thought about it like that.
Yeah, and just to answer your question in terms of machine learning, you see, back in the days, you know, people said, especially, you know, when algo trading was not around and you would, you know, input your trades manually and everything, people would say, you know, traders have like a gut feeling for the market going this way or that way or whatever, and it would take, you know, tens of, you know, years to realize if a trader was a good trader or not. And now with machine learning, you can immediately discard a strategy that doesn't work and, you know, move forward the strategy to like closer to production once you backtest it. So you see, there's always this kind of like ambivalence and sort of like this balance that you have to find in everything you do. It's much like, you know, in CS, right? You don't want to reinvent the wheel all the time, right? You don't want to write again all the modules that you're going to use. For example, if you use in Python, if you use NumPy and everything, you don't want to rewrite everything just to improve, you know, like the efficiency, because you're going to spend a significant amount of time doing it, and it's not guaranteed that you actually manage to do so. You know, same in trading. which markets do you want to trade on, how do you want to trade, and this is going to impact, your strategies and vice versa, right? It's a constantly evolving environment. So yeah.
Thank you for the question again, Catherine. Another question I have before we start opening up for Q&A is kind of looking at your professional trajectory and where you guys want to go and take your career. Are you looking to kind of move up the ranks more within HedgeTech? Kind of how is that upward mobility for first-year analysts that come in, and for yourselves? How's it been so far?
So for HedgeTech, as you know, a lot of trading company has two part of revenue. One revenue gets the money in, and the other part trade with this money to grow their capital. So for us, designated market making is the part that get us constant cash flow, and the other part, alpha-driven strategy, is the part that grows our capital.
Yeah.
So right now, the whole structure for the designated market making part is pretty much all set. I don't foresee a lot of huge changes in the future. However, in the future, we will be more focusing on maybe the alpha-driven strategy.
Yeah.
And expand to different market. And also one thing is that for alpha-driven strategies, we're mainly using machine learning models, since they require a huge amount of data, so they trade in a very small time scale. So usually these strategies are very low cap strategies, means the capacity is fairly low. A very small amount of money will reach the capacity of this strategy, because in a smaller time scale, if you have, for example, 0.1% slippage, then this will affect your strategy. So if the amount of overall capital is huge, then the strategy will not work. So in the future, our focus will also be expanding our capacity of the strategies.
Mm-hmm. And in terms of movement in the company, we encourage everyone who joins to be very creative in terms of like their approach. But like essentially what is going to make the cut is definitely the results and how curious you are, and what's your ability to learn after receiving a good education. What's your ability to learn outside of school, I would say, and apply this knowledge in a very creative way.
Awesome, thank you. Really appreciate you guys being so responsive to all of our questions. Now, to kind of give everyone who hasn't gotten a chance to speak yet some time, we're going to open up for Q&A. So if you have any questions, feel free to just unmute yourself, as a few of you have done in the past, or just raise your hand and I will call you.
So you guys have mentioned that you have a lot of machine learning models. What kind of data sets do you feed into these models, and what kind of results do you guys look for from the models?
So the data sets, we mainly use candle chart data,
right?
And I can reveal that most of our strategies are based on reinforcement learning. So our fitness function is usually a ratio that between the profit and potential risk, but it's not Sharpe ratio. It's a special ratio that we design internally.
So mostly price data. There's not much sentiment, if that's the question.
So just to follow up from that, like what differentiates the ratio that you guys have from the Sharpe ratio? Like what are the key differentiating factors?
It measures, it uses different measurement regarding the risk. Sharpe ratio use a fluctuation of the capital curve to describe risk. We have we use maximum drawdown to describe risk, different metrics.
Right. So the risk tolerance is our own risk tolerance, because we used to trade with other people's capital. Now it's not the case anymore. But our risk tolerance is embedded at the core of the strategy and the core of like the machine learning models.
Yeah. So basically, when we trade with other people's money, they will have, let's say, they will tell us that I wouldn't accept that our main capital falls under 90% of the original investment. That's why we mainly look at maximum drawdown for risk control.
And this is also because we trade on somewhat volatile markets, and so the drawdown actually matters a lot, because like you can you can wipe, you know, like weeks of profits in a few minutes or seconds. So, you know, it can be like a somewhat dangerous place to trade on, but yeah, definitely a key to our models. Let's see if we have anyone else. You guys are encouraged to ask questions if you have any. Could be on algo trading, could be on market making, could be on I don't know, like how to, like any like tips that we can give. I don't know if we can give a lot, but
So just going off my previous question, you guys mentioned that you don't use too much sentiment. Do you think there's possible room for like including sentiment analysis in some forms of algo trading? Like, do you think there's much value to it?
Yes, it definitely has value. However, the reason why we don't include a lot of sentiment right now is because our research team, most of the members of our research team don't have a lot of fundamental background.
right.
However, in the future, we will expand to include sentiment data as well.
Mm-hmm. On the markets that we trade on, it's not key for now, and it's true that you know, in order to increase the capacity of our strategies, as well as the markets that we trade on, we would definitely require sentiment analysis down the line. That's something.
Again, feel free to ask any questions that you feel comfortable asking. I'm sure they're willing to help out any way possible.
You guys also mentioned that you have a Singapore office. Are you like accepting internship positions or something of the sort in the Singapore office?
Right now, no, but in the future, there might be.
Yeah. So if you're interested, you know, you can always reach out to our team on the website, or directly, you know, to someone on LinkedIn or something. But yeah, for now, internships in Singapore per se, no. But you know, if you have an interesting background and if we see an opportunity in the near future, we will definitely keep your resume and your profile in mind.
Okay, thank you.
Mm-hmm. Anyone else?
I'll ask one more question. Just kind of curious. I was looking through your website right now, and in terms of getting started when working with I guess clients, you would say one thing you mentioned is that you guarantee a customized market making plan that suits the client's needs. So kind of once you get the information on the client, how do you guys go about executing it? Do you meet up with a representative from each team within your group, and then you guys kind of just come up with some type of proposal, introduce you to the client, and then just go about it? What's the, in terms of starting point to end point, how do you guys go about that?
Yeah, so that is mainly for designated market making. So for designated market making, usually the client has special requirement. For example, on this market, you have to make sure that spread is less than, for example, 0.5%. And you have to maintain like 10 orders on each side at all time. And so that's why we have this app for them to customize these parameters. So on our HT client app, they can just download this app and input the parameter. For example, input the spread they want to maintain, input how many orders they want to quote on each side all the time, and then the app will send a request to our server, and our server will start an algorithm to maintain the parameter that they requested. Mm-hmm. That's for the customization. And in terms how to move forward, usually we're algorithmic trading, so we trade directly on their account. So what they have to do is simply to create their account on the exchange and provide the API key to connect to their account with our algorithm, and they can start from there.
Mm-hmm. And obviously, from a risk perspective, they would also manage the permissions to the API keys. So obviously, you know, like you're not allowed to do certain things. Obviously, withdrawal, deposit, that kind of stuff. they would only give you access to trading functions and everything. And then yes, in terms of like the setup and the customization, it mostly goes with like their own requirement. For example, if they're issuers, the type of market that they're trading on, and like for example, the exchange requirements. Sometimes it's possible that different exchanges have different requirements. They require orders within a certain percentage around market price, and they require a certain amount of orders to be placed at all times and everything. So yeah.
Awesome, thank you. And one more quick question in terms of anyone here that's looking to get into the fintech industry, but maybe just didn't get a chance to ask a question or couldn't think of the right thing to say. Kind of what advice, this overarching advice at least, would you give as they go about their ventures here at Cornell? Whether it's be as active as you can, whether it's take those comp sci classes that you guys mentioned before, or whether it's being entrepreneurial and trying something new. What do you guys recommend?
The first question that's one has to ask himself or herself is whether or not you want to work for a big firm or not. It could be good, to have like a big name on your resume. It definitely helps. But at the same time, you're going to face, hierarchy, and you're going to face different, aspects that you wouldn't have in a smaller, company. So I guess, through internships, you can kind of get this sort of like perspective, whether or not you would like to evolve in this kind of like environment. So that's the first question that you have to ask yourself. The second thing I would say is to be curious, as I said, and try to expand beyond your horizons, right? So for people who want to, get into algo trading, for example, and they're studying CS, start looking into the financial or the finance, applications of what you're learning, either in or outside of school. And then conversely, for those that have a very finance heavy background, just start to get into like the more technical side, because this is something that we see, as we go, like the positions are increasingly technical, more and more technical. And so essentially, for example, we knew someone who was applying for like a sales position at a certain firm that I will not name, but the sales position almost looked like a software dev. Which was very surprising. Like the interview rounds that person had to go through were extremely tech heavy. So like just get technical if you can. So be curious is the first advice, and then apply your knowledge is the second advice, and then the third advice I would give is connections. Make sure that you build your connections in school and afterwards.
Yeah, and if you don't want to start in a big firm, you want to start with yourself. The best practice just to start trading yourself. There are a lot of markets that is very accessible in terms of data and money required, and you can just start designing and implementing your strategies from a very small amount, build your track record, and get a sense of what kind of problem you're going to face after the implementation.
Yep.
Yeah.
Awesome. Really appreciate it. Thank you guys. Again, you guys have been really responsive, and I hope everyone here can really take away from what you guys provide with us here today. Would you guys mind providing your emails in the chat below, or if anything, I can send a follow-up email for all the attendees. And
yeah, I think Kai is around. Kai, do you mind sharing our emails in the chat? That would be great.
Definitely, I could do that.
Thank you so much. But Laurent, Tom, thank you so much, and a big thank you to Connect as well. Spent a lot of time in terms of preparing the event and making sure that we kind of ran smoothly from the questions on the agenda to just overall setting up the Zoom and the calendar invite. So really appreciate you guys coming out here today, and again, thank you guys all for joining. All right, hope you guys found it useful.
Sounds good.
Thank you. Thank you guys for having us. Appreciate it.
Thank you.
Thank you.